Whether you're a work-to-live type of person or a live-to-work type of person, most of us dream of the freedom that comes with retirement. However, there are some huge mistakes that could be standing in your way. So let's talk about it. Hi there. As always, if you have questions, you can reach us in the comments below or at the number on the screen. We are licensed health insurance brokers and we're licensed nationwide with absolutely no charge for our services. Now today we're going to be talking about some of those huge mistakes you could be making that could be threatening your retirement. Make sure you stay tuned to the end of the video. The first huge mistake is not starting saving early enough. So get in that time machine and head on back. But barring that, start saving as early as possible. Now, yes, it's never too late, but it's also never too early. And even if you only have a little that you can set aside, that's certainly better than none at all, especially when we're taking into consideration compounding interest. So this is a retirement calculator provided by smartasset.com. There are so many different retirement calculators available. Some ask for more information, some less. The ones that ask for more information will probably give you a more accurate output, but they can be a little bit more overwhelming. So I don't want to really get hung up on all these numbers here. I just want to look at how when you start saving, how that affects your retirement. So the only thing I do want to change here is Social Security election age. We're going to change that to 67. We're going to talk about why you might want to do that later in the video. So as it has us right now, it has us in Charlotte with an annual income of $59,268. This is just the information that it automatically populated, saving 6% of our income. And right now it's put our birth year at 1989, making us about 35 years old. So right now, with that, it looks like to have sufficient savings for a lifestyle in retirement that covers your annual retirement expenses of an estimated $38,500. We recommend saving a minimum of $573 a month. So we'd need to up our monthly savings because right now it looks like it's estimating we would have $64,545 and we would need about $79,283, which means we would be pretty significantly short, about $15,000 short. Let's say, however, we were a few years younger, let's say 1995. So we kept all the other information exactly the same, and now instead we would be $13,000 short. Let's say even a little bit younger. Again, all the other information exactly the same, and now we'd be only $9,000 short. And the other thing I want to show you is this. Originally, it told us that it was recommending we save $573 a month. Now it's $384. And of course, if we did that 1995 instead, then it's recommending $463. So you can see that really the earlier you start saving, the better. And please don't just let your money sit there. Remember that whatever interest you're able to accrue on that money in your savings is probably not going to outpace inflation. So look into investments in stock markets, FSAs or HSAs if available. Look into maxing out your 401k or possibly starting an IRA. Make your money work for you. Now, speaking of 401ks, let's talk about the most common type of retirement account. 401ks began replacing pensions during the 1980s, and they are not the same guaranteed type of payout that pensions are. In fact, they're just not as good. 401ks require participation from you and your employer, and there are certainly ways that you can maximize your 401k. For example, match your employer's match. If your employer is willing to match 5% of your salary, if you can swing it, make sure you're contributing at least 5% as well. If they're able to match 10%, try to match 10% if you can. Otherwise, you're just leaving free money on the table. Now, after you've met your employer's match, for most people, the rest of your paycheck is probably better used elsewhere, unless you are a much higher earner looking to lower your taxable income. If that's the case, you may want to maximize your 401k contributions to lower your taxable income. Now, this is not the end of the story, and this is where we need to talk about the dark side of 401ks, because there are many hidden fees, especially when we're talking about those management fees. Very often, 401ks will charge you some type of additional management fee for someone to actually direct your investments. And this can majorly cut into your retirement savings. However, very often, you can actually direct your investments and therefore eliminate some of those management fees. So don't sleep on your 401k. Make sure you understand exactly what is happening in your account. Another huge mistake has to do with Social Security. Did you know that if you begin collecting too soon, your benefits will be significantly smaller? you could really be cutting yourself off at the knees. So if you were born in 1937 or earlier, your full retirement age is 65. If you were born in 1938, it's 65 and 2 months. 1939, 65 and 4 months. 1940, 65 and 6 months. 1941, 65 and 8 months. 1942, 65 and 10 months. 1943 through 1954, it's a flat 66. Then 1955, 66 and 2 months. 1956, 66 and 4 months. 1957, 66 and 6 months. 1958, 66 and 8 months. 1959, 66 and 10 months. And 1960 or later, that would be 67. Now, of course, as I said, you can start collecting as early as 62, or it could go up to 70. If you do decide to retire at age 62, then your benefits will be significantly reduced. And this chart will give you an overall idea, but there's actually a really great calculator on ssa.gov where you'll put in your specific information and it will give you a fixed number that is specific to your situation. But basically, this should give you an idea that if you were born between 1943 and 1954, your FRA is 66. Now, if you were to receive a $1,000 retirement benefit, it would be reduced by 25%, which brings you down to $750. If you were born in 1955 and you were to retire at 62, then your benefit, if it would ordinarily be $1,000, would be reduced down to $741, which is a 25.83% reduction. Now, why is it more? Well, that's because the full retirement age for those born between 1943 to 1954 is 66, and that means between 66 and 62, it's 48 months. However, if you were born in 1955, then you were to retire at age 62, then your full retirement age would be 66 and 2 months, which gives you a 50-month difference, hence the larger decrease. And that goes on, so on and so forth. You will see that it just continues to get larger and larger. Therefore, your benefits get smaller and smaller. And that is, of course, if you were to have a $1,000 benefit. But as I said, there is a more specific calculator on ssa.gov, which will actually give you your benefits, your actual amount based on your retirement age and your salary. And finally, let's talk about health insurance. And as health insurance brokers, this is, of course, our forte. Specifically, I want to talk about Medicare and some of the biggest Medicare mistakes you could be making. First, let's talk about Part B and the late enrollment penalty. So original Medicare is comprised of Part A and Part B. You'll likely be automatically enrolled when you turn 65. However, if you're not automatically enrolled, or you're someone who wishes to defer Part B, make sure that you maintain creditable coverage. Because if you go for a period of more than 12 months without maintaining creditable coverage, then you may be subject to the Part B late enrollment penalty. The Part B late enrollment penalty is 10% of the base beneficiary premium for every 12-month period that you are without creditable coverage. And this can add hundreds of dollars per year to your premiums. And remember, this is not a one-time fee. It gets tacked onto your monthly premium forever. Huge mistake. Another potential huge mistake has to do with Medicare Advantage. You'll probably see commercials or maybe even receive flyers singing the praises of certain Medicare Advantage plans. However, Medicare Advantage plans are not for everyone. Medicare Advantage plans are an alternative to Original Medicare. They must offer at least the same benefits as Original Medicare. However, very often they offer additional benefits as well. Things like dental, vision, hearing, prescription drug, and many more benefits. Also, very often these plans offer these additional benefits at no additional charge. Sometimes they'll advertise themselves as free, but that's absolutely not true. At the very least, you need to continue to pay for Part B. So when you're comparing the costs with the additional benefits, it's easy to see why these can be so appealing. However, there are definitely pitfalls with Medicare Advantage plans that you need to be aware of. First, Medicare Advantage plans are offered by private carriers and operate within networks. That can make it very difficult to find a specialist or even a hospital who accepts your plan, and sometimes people have to travel rather extensively to do so. Now, even if you do opt for a PPO as opposed to an HMO, which will give you more flexibility, Medicare Advantage plans are still managed care plans, which means that not only does your doctor have to approve a certain service or treatment, your insurance carrier does as well, and this can be extremely problematic. And the next big Medicare mistake I want to talk about is Medigap. Medicare supplement plans fill in the financial gaps of original Medicare. So original Medicare does provide truly comprehensive coverage, but there are financial gaps. Copays and coinsurance, deductibles, and there is no out-of-pocket maximum. That means if you have major medical needs, perhaps for an extended hospital stay or major surgeries or large treatments of some type, etc., you could have very large medical bills. And that's where Medicare supplement plans step in. They will fill in those financial gaps. So you'll pay an additional monthly premium, but most, if not all, of your out-of-pocket costs will be handled by your Medicare supplement plan. Now, many people feel that they're young and healthy and they don't really need to pay an additional monthly premium when they're not using their healthcare coverage that much. And that's totally understandable. However, if you wait, you could actually be charged more for your Medicare supplement plan or denied outright. And that's because in most states, you're really only guaranteed issue with no medical underwriting for your Medicare supplement plan in the first 6 months after you turn 65 and enroll in Part B. Should you choose to enroll outside that 6-month window, then you may be subject to medical underwriting, which means you could be charged more or denied. And when you've just received a major medical diagnosis, that's not the time you want to receive a denial letter as well. So what do you think? Are there any other major retirement mistakes that you could be avoiding? Let us know in the comments below, as well as any other tips and tricks. We'd love to hear from you. If you have questions about your Medicare or health insurance in general, you can reach us in the comments or at the number on the screen. As I mentioned earlier, we are licensed nationwide and there's absolutely no charge for our services. As always, thank you so much for watching and have a wonderful day. Bye-bye. Before you go, make sure to check out this video about long-term care insurance, which is not covered by original Medicare. And don't forget to like and subscribe. We'll see you next time.